Good morning, everyone. Welcome to this webcast on caveats, limitations, are they even real? We have with us Chairman of the Valuation Standards Board, C. Bhandari sir, Vice Chairman, C. MP Vijay Kumar sir, and Speaker of the session, C. Rajan Vadavan sir. He is the expert in the valuation, as we all know. And one good thing about him is that he was a member of the committee which prepared guidelines issued by IBBI in September 2020. So he will be able to answer all your queries and questions. And it is not a traditional kind of a webcast. It is planned based on so that you can learn better. We also have with us Sri Rakesh Sehgal sir, who is the director associated with the Valuation Standards Board. Over to you, Anil Bhandari sir.
Thank you, Sarika ji. A very good morning to all our members and viewers, and a very warm welcome to CA Rajan Vadavan ji, and of course a warm welcome to my friend and colleague in the council, CMP Vijay Kumar ji. MPV as a vice chairman has been a fantastic support for the Valuation Standards Board, and besides the fact that of course he's an expert on these topics as well as accounting and auditing standards. Rakeshi, welcome to you as well. I'm sure all of us are aware, and we believe that standards are a very important part of our attest function, not only attest function during the times of M&A, and also standards have been guided and are important from the perspective of regulators, whether it is SEBI, whether it is the income tax under the Income Tax Act, and so on and so forth. I think realizing that, and based on our experience in the Institute, I think the ICAI realized it long back, the importance of valuation standards, and that is the reason that I think ICAI was one of the first ones to come out with valuation standards long back, even before I believe, and I may be of course corrected, but even before I believe that the government started to, initiate this and establish the IBBI. So I think that was a very welcome move from the ICAI. I believe it was a thought leadership at that point in time. And we still are committed to that thought leadership. Myself and MP Vijay Kumar, along with our office team, Rakeshi and Sarika, we're committed to make sure that we take our valuation standards to a different height. We make sure that they are comparable or maybe even better than what we have across the world. And in some way, we continue to do this thought leadership within the Institute for our members, as well as for our valuers, registered valuers, and with the government. I think as it would be important for any professionals, standards are the guiding factors of what we do. And I know, and we've always heard that there's a lot of critic to say that, we have a lot of limitations and disclosures and disclaimers in our reports. Not only valuation reports, I think we do have such statements coming out in auditing reports as well. And I think it's important for us to express ourselves to the people at large, to the regulators, that the professionals are required to work in the boundary of standards. And when you work in the limitations and the boundaries of standards, there are always likely to be something which is outside those boundaries, because as professionals, whether you follow the standard or I follow the standard, the outcome expected should be same or similar. And with that in mind, there are likely to be disclaimers and limitations. Of course, you also sometimes do see reckless disclosures and limitations, which is of course not the expectation, and which is not up to the expectation or the mark of the regulators, or even for that, our purposes up to the mark of these standards. And I think this is a very, very important topic. And I'm really happy that Rajanji has taken out the time today. The fact that he has been part of the committee which has set the guidelines for limitations and disclosures is really, really good. And he would be able to give a lot of insights into the discussion and the topic today. Just to keep this very brief, I think we wanted to start this Sunday series as a learning series. Valuations and any standards typically become a little dry after some time. And we want to make this interesting. We want to make this interactive. And we want to make this into a learning experience. And that's the reason that, myself, MP Vijay Kumar, we thought, why don't we have easy Sundays discussing about topics around valuation, which sometimes could be tricky, sometimes could be very, very intricate, sometimes could be also getting into discussions and debates. So I think this is a fantastic opportunity for all of us, including myself, to learn around the valuation standards and hear from experts, their views, insights, And I'm really glad that, we could start this. And also during the pandemic, of course, while we do relax on a Sunday, it could become a learning experience for all of us. So thank you once again, Sarika, for putting this together. And I'm hoping that we continue to do this we're likely to do this almost every alternate Sundays. Is that right, Sarika?
Yes, sir. We have alternate Sundays. Next is on 6th June.
Lovely. So we're likely to do this alternate Sundays. So I would only say that please stay tuned to us and please make this interesting. We would probably do it on a VCM mode from the next Sunday onwards. But here we have a very, very interesting subject today. So I would request my friend and colleague MP Vijay Kumar to lead this session, be a moderator, and we could have this interactive session with Rajanji. So back to you, Sarika, if you have something. Otherwise, I'll request MPV to take over and start the session.
We can request MPV sir to take over the session.
So MPV, can I request you to initiate the session? And of course, then you would please take it as the way that you would like it. Thank you.
Thanks, Anil. Thanks for conceptualizing this interactive session. Having associated with standard setting and knowledge dissemination around standard setting, I think this interaction approach is very, very nice. In fact, I like the idea when you said it. It actually helps people to discuss about it and get to know more rather than being a monologue. So thank you for this conceptualization. And who better than Rajan himself, who is the author of these guidelines on behalf of IBBI, being available to share thoughts on what the differences are between caveats, limitations, and disclaimers. In fact,
so MPV, whenever we have critics, now we know whom to blame, right? Yeah, it becomes easier for us.
Yeah, but we will be with Rajan. We'll not let him alone.
Yeah.
So he's been doing a fantastic job for the profession of valuation, and is always available to the institute, particularly for knowledge dissemination and developing technical guidance. So thanks, Rajan, for accepting our invite and being available here. So without much ado, let me begin with the first query, and I would request the members who are attending today, if you have any questions, please do drop it in the chat box. I'll pick it up from there and share it with Rajan. So Rajan, to begin with, my interactions with people over time, even before valuation became a recognized profession, even before we had this valuation standard. And I recall when we drafted our ICAI valuation standards 202. I don't remember the para number. It's maybe para 11 or para 12. One of the last clauses in para 11 or para 12 talks about caveats, limitations, and closures. So we tend to have an impression that all the three are interchangeable words. They're very interchangeable words. But my understanding is these are three distinct terms, and each of them are quite different. So I request you to share your thoughts for better understanding of each of us here on what caveats are, what limitations are, and what disclaimers are.
Thank you, MPV. Thank you, Anilji, Rakeshji, and everyone in the Institute. It's always a privilege, to give something back to the profession from where you come up. So I always enjoy what Institute does, and that's why I'm always there to assist and all that. And the other thing is, I actually felt this format which you designed is going to be a very good format, because in this, people can also share their experiences of the interpretation or certain things vis-a-vis a monologue happening where a person is making a presentation. So this knowledge sharing, I would say it's different and it's good in certain way. I hope people will find it much more to their liking rather than just a presentation and then a Q&A. They can correlate some things to what they would have experienced in the past. So that's this thing. Now, coming on to the question, like what Mr. MPV asked, about caveats, limitation, and disclaimers. Caveats is the word which comes as warning, right? It's basically a warning or to the user who's going to be relying on a report that he should read that. It's like, if you remember CMA, when we started the Sale of Goods Act, caveat emptor, right? So caveat comes from that. Basically, it's a warning. Or please understand that, or these are the cautions which you keep in mind when you are using or reading a report. On the other side, now coming on to limitations will basically be from the perspective of a person who's performed the work. He could not or may not have been able to do certain processes, like today, caveat, the COVID is there, a person may not be able to do a physical verification. So it's a limitation. He could not say, so there is a shareholder dispute and he could not talk to another shareholder. That's a limitation on his piece of work. Sometimes, we get where there's an unlisted company, small company, where one person may be holding only 50 shares, only thing which he gets is the annual report. Now, in that case, he may not have access to the long-term plans, and he gives it to a person, please ask this, value this company. A valuer should be able to value it with all the limitations which are kept in mind, and he should bring those out. So that's the purpose of limitation. What stopped him from doing certain things? So those should be mentioned. Now, disclaimer again is to assist, that there is a contractual relationship or duty of care which a valuer may owe to one person and not to everyone. So he is pointing out what he is disclaiming, that he doesn't know anything about it. I'm telling it to you. Now, when a valuation is carried out or in a reports context, a limitation or a disclaimer, all these terms get used interchangeably because a disclaimer or a limitation could become a warning for the user of the report. So the person knows that the person who was performing the valuation, he could not carry out these procedures. So it's a warning for him. So hence, these terms tend to get used interchangeably. But it's very important. The user of a report is familiarized with what all these three things mean so that he can take an informed decision on the basis of that. That is the purpose of this thing. While it may offer protection to the valuer, it serves as a warning to this thing. It also defines or sets out the duty of care which a valuer may have. So the purpose of this is to the caveat limitation.
I think the network is low, right? I just wanted to, by the time that he comes up, I think I missed the caveat part of it. What did Rajanji say about the caveat? Oh, he's back. Okay, Rajanji, thank you. He was just trying to, yeah.
Sorry, I think the network maybe. What I was saying is, so all these three terms get used interchangeably. And they act as a caution to the user. They act as a limitation or provide a limitation with respect to the person who's performed the work, under what constraints he did that work. That is also given out. And similarly, it also sets out the contractual obligation or duty of care. So the purpose of this is this, and that's what I'm saying. When IBBI also formed this committee, they accepted these three things, and hence the guidelines and everything, the paper which came out, it is quite comprehensive in a number of ways. And the paper itself puts this out that these terms get interchangeably used, but the context of all three is different. That they can be to protect someone else, but a limitation or disclaimer at any point of time could easily become a caveat or a warning for the user that, look, the valuer was not able to perform these processes or procedures. And hence, it's up to you as a user whether to rely on that report or maybe ask that person to do something more.
Yeah, I appreciate Rajan. In fact, so nicely brought out. Just for the benefit of all the members, Tarika was mentioning in her introductory remarks about the September 20 IBBI guidelines, where Rajan was one of the committee members in drafting this, where the annexure part of it, para 1, 2, 3, very clearly bring out the distinction between caveat, limitation, and disclaimer. And Rajan, is it right to say that people should not confuse this words disclaimer here in evaluation with the expression disclaimer which we use in the context of audit report? So in the context of audit report, disclaimer would mean that I'm not giving any opinion at all. So I'm just staying away from it. Whereas here it is not necessarily same. So I think while the term is same, I think both of them have a completely different connotation. So maybe you'd like to articulate that a little for the benefit of all.
I agree what you're saying, because in the context of an audit, if we give a disclaimer, we say that, we disown kind of a thing for the audited accounts which have been provided to me by the management, right? Whereas over here in a disclaimer, I would say I have performed this work with certain limitations, and these are certain things, because unlike assurance or the audit, what we call, we are checking the historical data. Over here in case of evaluation, you're also looking at the future projections, the prognosis, and all that stuff. So hence, that's what I say. Like what they say is valuation is an art come science, right? It's a science in terms of the methodologies which have been spelled out are clear. Like you're going to use a DCF approach, you're going to use a multiples approach or a NAV approach to the extent what you can apply. But the subjectivity or the art comes in when you're trying to apply that approach, because it's those judgmental aspects. So hence, all those things combined are what we keep in mind when we are doing it. But the terms, like what you rightly said, they can get used interchangeably. They do not have to be viewed in the context of assurance as similar to an audit. But a person may put this out that, suppose I've carried out a valuation, however, there is this inventory which is lying there which I have not been able to verify, right? Now, this can be a disclaimer as well, as because it's a certain portion of the work which he could not do. Similarly, it's also a limitation, right? Because to the extent whatever job work he was performing, he could not carry out that work. So to that extent that there is a bit of interchangeability or terminology which can they get mixed up in that sense.
Rajanji, and sorry to interject, and what I was wanting to understand is sometimes a disclaimer or a limitation has a profound impact on what you're trying to do, right? And I'm sure this would be covered in the guidelines that you have come out with, but for the benefit of everybody, how do you address, say, for example, if valuing the inventory or doing a physical verification was a critical part of that activity? Can you still live with that disclaimer because it's going to materially impact the valuation? So is that still okay?
No, so I would put it in a different context. One is, if you take a look at even the guidelines, they set out what a report, of a valuation report, what all things it should allude to. Now, obviously, whatever references you give out in the report, they have to kept in the mind of they have to be given out keeping in mind aspects of confidentiality of the client, because there is a possibility if you try disclosing the future projection. Now, in the case of a listed company, it's just not possible because you're giving out forward-looking statements. Similarly, for a large unlisted company, you can take the board-approved plan, right? But you may not be able to put it out even if there are some minority shareholders, because that information is not meant out to be there, because even competitors could misuse that information, right? And as a minority shareholder, you're only getting the annual report and you're not taking part in the decision making. So these are certain things which a person should allude to what all has been done in the report. And if the report provides all this information in a very basic format, also it takes care of this thing. Now coming on to certain specific procedure, like if you've not been able to perform, what is the reason for you not being able to perform is what should be set out, right? Which can be that I did not find any comparable. I could not do it. Now, coming on to your specific issue around inventory valuation, right? If I was not able to do a physical verification, now physical verification of inventory can also be a bit of I think that's where a person needs to go beyond thinking about a physical verification. He needs to think like all of us are accountants, right? When we do, even at the time of a stock take at the year end, right? You go on that particular date and you do the physical stock take, or you observe what the physical stock take with the management is doing, and then you assess a value of the inventory, which could be LIFO, FIFO, any of those methodologies, or using an external person to value if it's a coal or a cotton, but what is this thing. Now coming on to this aspect of if you're doing a IBBI kind of evaluation or an insolvency valuation. Now, insolvency valuation, first is you've got a cut-off balance sheet, which has been given to you. You got all your sheets on that basis. You could be going much later, they say 60 days later. Now the issue is, I cannot see what was the inventory physically there on that particular date, or on the valuation date for which this thing I'm going later. What is the procedure which I can use? I think I'll have to wear perhaps my auditor's hat or something else and try to examine or work back the inventory levels which I see on that date and try to see or broadly check that they corroborate with the data which could have existed in the balance sheet on that date.
Sure.
I need to move beyond that. See, it's like finished goods if it is there. Now I cannot go after 60 days and see whether it existed or not. So what do I do? I can only verify it by doing what is the finished stock today, and I work backwards. Second is I look at the sales and see, yes, did the sale of that much stuff happen? I can perform those kind of reconciliations and do something. But just to say that I was not able to do, that maybe, someone could question, why couldn't you do it? So it's like, I think that professional skepticism cannot be foregone whenever you're carrying out any of these.
Got you.
Anil, actually, the important point is that the term limitation here and disclaimer are not similar to the same expressions we have in the context of be it audit standard or internal audit standard. So if you have a scope limitation, which is very serious, you actually walk out of the assignment as well. Whereas here it doesn't mean that. So here it requires you to spell out and still give your valuation. So those kind of guidance.
So what you're saying, MPV, is that the important differentiator is that in spite of the fact that there is a material procedure to be conducted or a test to be performed to arrive at a value, even if you're not able to do that, you may still arrive at a value with that limitation and disclosure. That's what you're trying to say.
Correct. So that's
but the important thing on this is that you need to clearly spell out all these things, what you've not been able to do. Because that is the biggest challenge if you're not putting that out, what you've not been able to do and all that. Because let's take a case now, IBBI, when they are looking at any of the valuation reports or a IRP or a COC, the committee of creditors or the IRP should be very well aware, right? This value is there because or this work I could not perform. Either enable me to perform it, I can do that.
Yeah, my only worry is that valuation becomes a very important aspect of anything that you do. And if you are able to follow limitations and disclaimers, which is beyond a professional judgments or beyond your professional, how should I put it? Like, for example, you said you could always do something else to probably try and see if there was a conclusion around it. But somebody just doesn't want to do that. So then the value could be completely different from what it should be. And then we are walking on a very thin line as professionals because we could have a lot of people questioning our limitations and disclaimers. So, and then sometimes we get questioned as professionals that, look, like you said, Rajanji, that you could have probably performed some other tests or procedures to probably make sure that you know what you're doing. So sometimes it gets a little tricky. And that is why, I kind of, wanted to highlight this. But I get your point. So, yeah, MP, back to you.
Very valid point, Anil. In fact, in most valuations, you end up with almost a template-based laundry list of caveats, limitations, and disclaimers. And the purpose of the September 20 guidelines of IBBI say that, look, you can't escape your liability on this basis. You can't escape your responsibility on this basis. So you are required to perform your work, and these are extent to which you can use caveats, limitation, disclaimer. So it is in that context. What you said is absolutely right. That's the big concern of IBBI. Rajan, if I can go forward for the discussion.
Can I just supplement, MP, what you were saying?
Please.
See, the guidelines, if you look at them, they say they are quite exhaustive. What the IBBI has even given out, huh? They cover you this thing, but what they are saying is certain things. Please just don't say that I have taken this, what management told me to do, and I just did that. Have you applied your professional skepticism or your analysis on that? That is why they want an affirmative statement that you've reviewed and analyzed what was given to you, rather than just saying, because what happened in a number of cases, what was coming was, I have done this basis what management told me. Management told me use a discount rate. Management told me this is this. Please take this as the value. Then what are you doing? You need to see whatever management has told you. Have you reviewed and analyzed it? Is it perfectly fine for you to put your signature? That is what IBPI guidelines are. The guidelines are very exhaustive.
Thanks, Rajan. I appreciate it. Rajan, just taking this one step forward. Before that, Anil, credit to you. I understand there are more than 2,000 members who have logged in on a Sunday to interact on this topic. Sincere thanks to all those who have shown interest to join here. We look forward to having questions from you also to Rajan, and to make this more interactive and to also get your practical insights. Thank you all for joining today, and thanks Anil once again for conceptualizing this so well. So Rajan, going one step forward, see, if you look at the valuation exercise, you also mentioned during the course of responding to the previous query that there are lots of assumptions which are involved in a valuation exercise. So now, do those assumptions qualify as caveats? Can somebody say they are also caveats?
No, the assumptions is a data which has been provided to you by your client or someone. The work thereon, what you've done, yes, you can have a scenario 1, scenario 2, scenario 3 valuation, because we are talking about future, right? If someone was to say that if I was to do this was my plan, I can have this thing. If this is the plan, then what are the parameters which can change the value? Now that's a separate thing. What we call it's not a pure play valuation for submission. That's what I call in my parlance, because I've been living and doing valuation for a long time. We call it as value creation or a value this thing supplementer. If someone wants to understand that if I was to put up this plot and this plan so there, then what could be the incremental to the base value which I have? Those are certain different things. But I'm just saying, coming on to when you're saying assumption is a data which has been given to you, right? It's not a caveat. It's something. Now it is up to you that what work you've done on that data. You need to review it, analyze it properly, and then put it out. Whether you accept it or you don't accept it. You need to, as a valuer, have adequate comfort on it. If you're not comfortable with that, then just by putting that this has been given to me by the management, you cannot change it, but there are certain things which are still in your control, right? The risk is in your control, that what discount rate you can use. You do not agree with it. You can say this is what they've given. I'm in for my, but I can't do. I can't be creating my own projections as a valuer also, because I'm not, because that will defeat. It'll come to the same purpose of a self audit or a self attest kind of a thing. But why, if it is giving you discomforting results or something, you can always put that out as a challenge, right? At the end of it, the discount rate or any adjustments which you're going to do, that's your decision. That's not the decision of the management. Management is only giving you XYZ this thing. Now they may say, okay, please take the value of land at this. Now it is for me, they've told me that land, whether I accept it or not, on the basis of the basic research which I may do, that the value is different. I can make an adjustment to it, right? In my view, this is the opinion. They have given me this, but I think I have changed it, or I can play around when I'm doing it.
Yeah, I
But
agree,
this
Rajan.
limitation, I'm saying, or this thing also, as a valuer, I drive much more comfort on using the projection by the management by doing some very basic things like, is it a long-term plan which has been approved by the board or the management, doing a comparison with the historical analysis. Obviously, you need to get into a discussion and understand it. Are the assumptions which have been given to you bordering on unreal, or are they looking realistic to what you've been doing in the past, what you could be doing? So all those aspects need to be kept in mind. You need to be, at the end of it, convinced about the story or the assumptions which have been given to you. As so Damodaran also says, it's, this you need to, putting the numbers is in one place, but your ability to comprehend the numbers which have come in and how you write that out in the report, acceptability and all that. The convincing thing is yours. You as a professional is also accepting it. So it's your buy-in to all that, what you've done.
Yeah. No, good, Rajan. In fact, I'd just like to add one point on top of this. Even in the case of an audit, when you have a valuation report, let's assume for an impairment of assets, it is important for the auditor to satisfy himself or herself on the assumptions which have been taken by the person who has done the impairment valuation. The auditor will not be absolved of responsibility, stating that I have followed the valuation report as is. So that freedom is not there in the audit standards. So what you explained is so true. So I don't think someone can just say that I took the value management's information as it is. You are required to apply your own professional judgment.
So I just have a follow-up question on that. I think what both of you have been discussing, NPV.
Yes, Anil, please.
The first point about a valuation always starts with the projections given and approved by the board or whatever of the management, and typically for a DCF. What is the kind of test or approach that one would need to do to try and make sure that your disclaimers or your limitations around that is appropriately addressed?
No, so whenever I take the projections which have been given to me by the management, I look at them, like I said, if it's a large corporate which has got its own independent board and everything, and they are a part, all corporates barring right now because of COVID, the situation is very fluid. But a typical corporate always make plans for 3, 4, 5 years, right?
Yeah.
Those are the business plans which are internally debated. Everyone makes, even it could be an annual plan, right? So you see whether those have been reviewed by the board, debated, or someone is just giving you something, one model here, one model here.
We could discuss about, Rajanji, I was more coming to a point of review and analyze. So
that's
saying,
what I was coming to. That's where I'm coming to then. So as a first step is, who's giving you those numbers is one check which I do. Second is then I analyze it from the basis of the historically how that has performed, and then try to see the projections which are being given out, how they are matching up, or is the storyline right with what the company has been doing in the past, or the business the way it has been done, or what is happening in the industry. And keeping those aspects in mind, I review the future projections which have been given to me. And then I get the comfort around them or a storyline around them. And this especially becomes more challenging when you're having, suppose a new project is coming online, right? The management may say this project will come online. Now the questions, right? We are all auditors also at the end of it. When we get the impairment analysis and all that, we take a look at the board meetings, what has been discussed, what are the plans which have happened in between, whether this market study is there which can support these numbers. how's the market growing. So you do all those stuff and then do it. Now, obviously, there comes a word called limitation, right? Because limitation in the sense is how much work you can also perform in a particular date. Let's also not forget, a valuer does not have the same access as an auditor may have. And he's not doing any investigations. And he's not doing any investigation, or he's not a this forensic auditor. So he's got the historical summarized data, he's got historical projected data, he can ask questions around that and perform the job accordingly.
True.
Yeah. So if you can just go to the next question. This is again a question which keeps coming up often, Rajan, particularly while valuing unlisted entities. Those entities are obviously unable to use a market approach. So, such circumstances, what kind of disclosures are required in a valuation report? So, how do you deal with those cases?
See, I do it in a. I like I said, I just broad based my analysis a bit more. One is that unlisted company which we are talking about. I try to see if I can find any comparable which is operating in that space, and listed company in that space. If I can find that, then I also look at if any transactions have happened in that space. Now again, it's a question of R&D I may need to check out into any databases and try to get. Then if I cannot find something exactly the same, I try to find surrogates if available. I will do that. But a number of times I might say that the market analysis which I may perform may be supplemental or to the analysis which I may perform using a DCF. But I should disclose that out in my report. That's what I would do. It's very possible number of time private companies you will not be able to find direct comparables or something. So I'll try to see what is the closest proximity which I can find to someone who's operating in that industry. If not, I will adequately caveat it out also in my report that I could find out this, and I've done it on that basis. But then my primary approach has been, say, an income approach or something. But I still try to, perhaps in my working papers, I may like to, do a benchmark analysis or using any of the possibilities around the papers or something, comparables if I can get. But you said that it is a challenge. It is a big challenge, especially in our in a country like India, where we've not had that kind of studies also, where the data could be available that anything trading in a particular industry has typically had a trading history, that transactions have happened at this space. So it's always an effort that you start from the beginning at that point of time, try to get that data.
Rajan, just continuing on something similar. So we all come across a few situations where different valuers arrive at a different estimate of value for the same asset, even when the purpose and circumstances in which valuation is undertaken is the same. People often quote the case of Kingfisher Airlines here. Because of this, the ability of valuer and integrity of valuation process, people don't get too much confidence in it, or at times they question as well. If a registered valuer faces a similar situation based on your experience, what would be your guidance in terms of caveats or a limitation or a disclaimer which a registered valuer needs to state so that tomorrow he can defend himself? And what kind of documents and evidence the person needs to complete? Just because what you mentioned and the response to previous working papers, ensure that tomorrow they can stand the test of a legal process or a peer review of a valuation as well?
Yeah, very good question. Maybe you know it, I know it, we've gone through it. See, couple of things which one does need to keep in mind. First is valuation is always at a particular point of time. So value can change over a period. In fact, it can change within a very short span also of this thing. Depending on some regulatory change happening, something happening, the value can change. Valuation is always at a particular point of time. The important thing to note is the data same which is being given to the two valuer? Because suppose if one valuer gets one data, another valuer gets another data, the value, there is a high probability of both coming to a different conclusion because the view on the achievability of that can be different. So typically in any shareholder dispute or any of these matters, the best way to approach them is try to say ki if there is a approved business plan which you use, okay, fine, let's get that, use that as a base. Both the shareholders can provide their views how that can be different, and then you can apply it and all that stuff. So in the case of Kingfisher, that is another question, whether the base data was same, whether it was being carried out at the same point of time or no. That is again a question mark. Thirdly is the way that airline was going down also. One does need to keep in mind that the value the value was deteriorating like something fast, right? 3 months back, it may have had this much cash to pay out these liabilities to run this thing next. I may not have. So all the liabilities are also mounting up. The equity value can also change with the liabilities which are changing the position, which is changing at a particular point in time. So one does need to keep all these aspects in mind. Now, usually if the data is the same for two valuers and same methodologies are applied, I think the value conclusion should be in proximity. They should not be diverging significantly. I'll give you an example. In the case of IBBI valuation, some of them which I was doing and as you know, two valuers are appointed for the valuation. Now, on the business side, okay, coming on to certain value of certain leased land. Now, one person might say that no, I will compare it with the freehold land which has got sold around in that area at that prices. That's fine. Now the price is also into a particular band. So my view on that could be different from that other person's, or what discount I may apply or what rate I may use. However, they will be in the proximity this thing. A fundamental difference can also be, suppose that land has been leased out for that plant, and the government undertaking which has given that land on lease says in case the company goes into liquidation and all that, this land will revert back to the government. Now, if I am performing a liquidation valuation, my call will be that the value of that land for creditors or anything is zero. And hence, trying to make it comparable to the land prices in the vicinity is incorrect. But someone else may have done that valuation, say even a month back on using this thing, but he was doing evaluations for a going concern. He may have taken what could have cost him to build that plant and all that. So those are certain aspects which one does need to keep in mind. In fact, initially it happened when, if you recollect, when the dirty dozen, as the IBBI ones were there, so they were talking about, initially it happened, suddenly people said the value of this is, the original value was given at this and now it is this. It has been given. Yes, the problem also is that when a valuation was done at that point of time, the situation may have been much better because of the elapsing of time over last 2 years. If the case has been continuing, there could be a further fall in the value.
Yeah, it's like the famous spectrum valuation that we had, right? Where I think value is in the mind of the person who is valuing it, right? So
yeah, obviously, at the end of it, aapko bhi pata, mujhe pata, we all go and suppose you were to go out and buy a house, right? Let's be clear. For that same house, we could offer a different price. I'm saying the inherent value could be X, but someone could offer a different price for it, which should be in the close proximity, keeping in mind.
So would it be safe to say that a valuer, if he puts as much as of his mind on the document that he's creating, as much as he can, in terms of assumptions, clarifications, notes, calculations, that would be probably a good valuation report to defend under any circumstance.
His working paper should support all that. He may not disclose everything out, like I said, keeping in mind the aspect of confidentiality and everything. But obviously, like I said, science is there because the methodologies are clearly laid out, right? You have to follow these 3 methodologies. The art is the subjectivity. For a particular thing, you may apply a 10% discount, I may apply a 15% discount.
Correct.
But that is an individual judgment. So to the extent you can justify it, you will try to justify why you are making that discount. But that is subjective. There is no you cannot put a prescription around that apply a 5%, 10%
but
for this and all.
Isn't at the end of the day, after so many valuation reports being, and sorry MPV, I'm just I'm very tempted from my own learning experience. After having done maybe 100, 500, 1,000, 2,000 valuation reports, you only come to maybe 100 tricky items. There cannot be more than 100 or 200 tricky items. One, for example, you said is about the lease land, for example. And if you look at it historically and futuristic also, there'll be only 4 ways to deal with that situation. Or maybe there will be 5 ways to deal with that situation. Is it not possible for us to kind of, try and bring this in a box where we say that, look, these are the 4 ways to deal with that. And typically the discount range could be between 10, 15 or 20% because historically or futuristically, this is what is likely to happen. So of course, this is again based on your experience, and that's why I'm trying to take the leverage on that. Because in life, how much ever you look at it, we find there are too many things, it's too complex, but eventually when you look at it in the past, you realize that there were only 20 variables or there were only 10 variables and there are only maybe 10 ways to go about in the 10 variables. What's your take on that?
I agree for certain standardized valuations, perhaps you can do that, but there will obviously be, I have seen typically each valuation has its own nuances also. Otherwise, it's very simple that DCF is what, right? At the end of it, it's an Excel spreadsheet which is put in there, and you can, there are 7 or 8 variables, right, in a DCF. You can very well put that out as a spreadsheet. Data comes in, results comes out, right? The important thing on that is certain parameters, the analysis which you do. Those are the calls which make the difference to the output, right? It can easily be garbage in, garbage out. You can always put the P&L or projected this thing in there. Fine, I put that in. Now, is it in line with the historical and all that? When I do my analysis, is the profitability in line with what I've been achieving in the past? Is it in line with what the industry players have been doing? Have I done that analysis? If I've done that, all that is comfortable. There is a particular discount rate. Again, there's a formula to it. You do that. But then there comes the question of what is the risk element which you think on the achievability of all that. You apply to that. And you can get the number can be different, right? There are now softwares available in abundance where a person can simply put in the data and come out with a number. Now, the question is, has that data been analyzed by the software? I don't think so. That is where you, me, as professionals need to apply, or apply their judgment or analysis to agree with what the output which you are getting. That human mind thing you will not take away. The computer will not do the thinking for you. But yes, there are only 7 or 8 facets in any income approach or in a DCF. There are only 6 or 8 this thing. But let's take a look at market. I think the scope becomes a bit wary. You cannot just blindly say use, for this industry, use this as a parameter. It has to be kept in mind whether it's fitting in, because even the comparables may have subtle differences. Today you are valuing a company and you try to apply a multiple which is applicable to another company. Otherwise, there can be a difference in a simple thing like one company may not even own the brand name.
True.
One company is only a trading company, another company has also got its manufacturing outfit. So those are certain things which only once you get into it, you can do it. So it cannot be made very prescriptive in that sense. Yes, but the basic guiding lights, what you said, the valuation standards which they provide, that the application of mind thing is very critical in that thing.
True. Back to MPV.
Yeah. So just if we can conclude this long discussion on this item, my 2 cents, Anil and Rajan, is I think the valuation process followed is extremely important for somebody to arrive at the right outcome and also to defend it later. And second, my experience of having interacted and dealt with valuation assignments over time, the subject matter expertise of the valuer for the asset concerned, the depth of understanding of the asset being valued makes a difference. These are 2 things I've seen. So if you can just come back to the queries, I have 2 questions around this pandemic, and I don't think it's likely to go away anytime soon, Rajan. Of course, before we started, Anil was giving little positive indications about how is it in Mumbai. But having said that, so if you take the case of an assignment of inventory valuation, we all know valuers have a limitation in terms of physically verifying it. And in this scenario, for a valuation exercise, where do this fit in? Do this come in as a limitation, or is it a disclaimer? Where do they come in?
So I would look at it in 2 ways, right? Pandemic itself has now become a caveat, right? A big caveat, because any projections which you may get, even I'm just saying, let's not move away from inventory right now. We always thought that early in January, February or March, till early March, we were thinking we are out of it. Things are going to be back to normal. 2021 was an aberration, but now we are seeing that this year, how it has happened in the first 2 months itself, we are all locked out and the business operations and everything is. So any plans which perhaps may have got board approved in certain ways or agreed in a particular day in December, they could undergo a change now with whatever is happening. So that's a caveat which someone should highlight in his or her report in a way. Second is, it is also, and now coming on to what MPV you were talking about, is coming to around about you being able to do any physical verification and all that. That's a limitation because you cannot perform that job. So you should highlight that. Now comes the question, now we are also, as auditors or something, we are also auditing the accounts. The companies are declaring results in a lot of places. Physical verifications could not be carried out on that particular date, or you could not have gone because of the travel lockdowns and all that. Over there also we are relying on supplemental procedures to agree with whatever has come up, right, on that thing. Like I said, about finished goods, you are checking all the supplemental records thereafter, whether that inventory existed, was it sold, how fast did it get sold, has it got realized and all that to justify the value or the carrying value on 31st of March in the account. So I think we'll have to do some of those only in this case to do this thing. However, we'll need to clearly outline the limitations on the work because of this, this aspect which has happened. And especially it is more relevant for IBBI or any of these cases. So if you're doing it for internal company or something, that is different vis-a-vis if your report is going to be going to third parties who are going to be placing reliance on it. I think it should be clearly spelled out in the report what work you could not do.
Okay. Rajan, actually on inventory, I have another very interesting question which I have got. I'm not sure whether it is in the scope of valuer, but I'm sure many of those who are listening now would have such a query in their mind. So if there is a valuation assignment of a cotton mill, a textile mill, and an inventory valuation needs to be done of, say, cotton, in such a situation, is it the responsibility of valuer to stick to the stick test and justify the quantification and measurement of cotton available, or is he required to apply his common sense, logical mind, and his experience as to why such inventory is lying in stock and why it's not getting consumed if it is fit for use? So, what would be your answer on this? Just take it what is there, or should you apply and see that why is it lying there as well, and bring that experience or questioning mind while arriving at a value?
So over here, maybe Anil, I would perhaps wear my article clerk days or my auditor's hat also. And, like, let's take the example of a cotton, right? At the end of it, it's a seasonal crop. You could be storing it for a while, right, to last the whole year, or till the next crop comes in for a yarn mill to do it. However, certain thing which I would do, besides doing a physical verification, now it's there in bundles and bundles. I can't be doing 100% counting and all that. What can I do? I will have to do some sort of test sampling and all that. Second thing, I will have to see what is the date on which what came in and what's the usage and all that history. I would like to verify some of these facts before I give a number to the value. And that's true whenever, if you've been also been doing your annual audits and all that, that's how you do it, right? You do look at how old that inventory is it getting used, not getting used, when did you buy it, at what price, what are the supplemental documentation which you can keep for your working papers to rely on that. That's the way I would do it. And especially, it's not only cotton, it can be true for a steel mill, where you may have heaps and mounds of coal or iron ore lying there. Now, if that coal is not getting used while the steel mill has been working for last so many days, there is some problem with that coal, right? Either it could be higher ash content, or it could be calorific value is different. So you do need to make an adjustment basis your discussion then with this thing. Similarly, if the ore is not getting used while the mill has been running, so there is some problem with the ore, and you may need to adjust or the value of that stuff if it has not been used for 6 months. You're not a cotton. Similarly, whatever would have come in a particular year should get used within that year. You cannot have stocks which are lying for 3 years and not getting used. So that should put some red flag should get raised if you're facing any of these situations.
Okay. Rajan, on inventory, one more query. See, there are certain items of inventory which are quite very technical or specialized. Say, for example, petroleum. So those cases, you are likely to rely on the work of another expert, and our valuation standards allow you to do so. So in such scenario, from your experience, what would be your guidance to the members who are listening to us now on the do's and don'ts for a valuer, and in the context of limitations and disclaimers, which is the topic we are discussing now? So what is it that we need to state in our report without diluting our responsibility?
See, I think the guidelines are very clear. Eventual responsibility lies with the person who's signing off on the final report. So if you are using or relying on the work of another expert, you can do that. But please view it or analyze it in the same way as another user of your report is going to be reading your report, and he can ask questions. So you should get comfort on whatever the work someone else has done. That before you sign off, eventually it's your responsibility. Now coming on to the specific thing where you are using a specialist, right? Say a petroleum and all that. Yes, you will have to use that. You will see what procedures has he followed. Did he do some basic things like how do you value a petroleum, this thing? Did he do some physical verification? He would have used a formula to do that. Now that you need to assess what procedures did he perform, and see his report. That is he putting in any disclaimer, caveats, or limitations in his working papers that he could not perform that, and what implication that has on your your report. So you do need to, and that's why I said in the past, whenever we've been doing the sessions, a person should also carefully read a security and financial assets valuer should also read the disclaimers which have been provided in the guidelines with respect to physical assets, and be conversant with them or understand them. What is the person who's giving out a report over there? What is he trying to say? Otherwise, you do need to ask questions because eventual responsibility is with you.
I agree. And we have similar provisions even in the context of audit standards as well.
Exactly. Relying on the work of an expert. We do that.
Yeah,
right?
yes.
That just brings me to a question: is a conservative valuer the best valuer?
I have an answer on this. Undervaluing is wrong, overvaluing is wrong. So you have to get there.
Let's hear Rajan, what is his view on this?
Okay, fine.
Because at any point in time, a valuation is called in question. Of course, not at that point in time, it's called in question later. And a conservative valuer always holds on here. So is he the best? Rajanji, what's your view?
I would say a realistic valuer, not a conservative or this thing. Obviously, the bigger problem, rightly what you said, Anilji, is, you know what, which is all your valuation get analyzed later.
Correct.
Where, you at that point of time when you did a valuation, these facts and circumstances existed. Now, anyone with a hindsight can try to poke 20 holes into it.
So would it be a good thing for us to describe in our disclaimer or a limitation to say this valuation report is valid for 30 days? And
see, you can't say that. The valuation report, what you say is valuation report is of that particular date, based on the data and facts which I may have at that point of time. Now, the best laid plans of any corporate or anyone may or may not realize, right? Who would have thought COVID could have changed so much?
Yeah, no. So, I mean, of course.
There is an anti-dumping duty which comes into place after 6 months.
I agree. 30 days was just loud thinking. I'm only saying that as professionals, we should be worried about the fact that either a SEBI or an income tax or a regulator or somebody who's aggrieved for whatever reason, we would have given a valuation, he would have been very happy. Suddenly he's not happy. And there's always a possibility that as professionals, people come back to us. It's like, doctor, he did a fantastic job. But of course, if something goes wrong, he's not a good doctor. So how do we kind of, protect ourselves? Not really protect, but put it in the right perspective. Yeah.
Typically, the way I caveat it in my report is I've considered the facts till the valuation date and till the date of my signing of the report. Whatever was available with me. I don't know anything about the future.
Actually, the standards are so beautifully drafted.
Yeah.
It's in the interest of all stakeholders, including the valuer. Valuation is always as
a point in time.
Full stop.
Correct.
It's not valid even for the next day. It's not even valid for the next day. It's only for that particular day. So let's say I do a valuation as on 31st March 2021 and sign it off today on 22nd May. This is the value I'm signing today as to what was the value on 31st March. It does not mean it is the value of that asset on 2nd April or 5th April or not. So that part is extremely clear that there are no...
So how do we stop this? How do we stop this witch hunt, as I may call it, which is hindsight? See, hindsight is like a god, So how do you ensure that we are able to, and this is a larger question, of course, for IBBI and everybody, how do we ensure that, or maybe how do we protect ourselves in the report or whatever? I don't know. Any thoughts that anybody would have? Welcome.
Two ways. One is I would like to just draw on up an example of what MPV said, right? Suppose I'm doing a valuation of a company on 31st March and I'm signing off a report on 21st. Perfectly fine. I will take what was the situation as of 31st March. I will take into account certain factors which I may become aware of when I've signed up on 21st of May, finish it off. This is my assessment. Because the reason is, suppose if I was to say I will only consider factors till 31st March, it is quite possible, suppose floods happened in that place and the plant got washed away. Now, if I was to say I'm signing on 31st March valuation, and knowing on 21st March when that plant does not exist, I cannot ascribe that value. It's a significant event which has happened. So any significant events or the factors which have happened between 31st March and the date of my signing, I should obviously consider. That is one thing which I'll keep in mind. Now comes the question about the witch hunt. That's where I think the analysis, what you've done on what data you got, that is the most important, or that is what will support you. What did you keep in your working papers to support? What are analysis which you did? Those working papers are the most important thing which will come to save you.
Is there a time limitation like how you have in the court of law? Is there a time limitation, or is that a good idea to have a time limitation? You cannot question this valuation report after 3 years.
It again depends in the context, right? Let's take an example. Typically, Reserve Bank of India doesn't want any valuation reports which are more than 3 months from the valuation date and this thing. So they say typically a valuation report is valid for a period of 3 months is typically what they use. Now, I'll give you another example, which is suppose a company has announced a merger. A valuation report has been given. Now, the court scheme itself can take a couple of years. Now, you can't draw a line around that. With those shareholders and everyone has voted on that particular date. So, it has to be, and let's take the case of an income tax, right? I may do the valuation today. वो assessment 4 साल बाद हो रहा है.
जी.
And that's when it goes. So how can you say that the report is not valid? Because I did the valuation in and around the date when the transaction happened. You are reviewing it now, and then you try to compare. The business plans and projections were like this.
I'm saying, how do we stop that? I'm saying, Rajanji, how do we stop that in a standard? How do I say that, like even the courts of the law say that you cannot come back to me after 3 years or whatever the limitation is. And of course, let the income tax take their own sweet time. They could even take 10 years for all we care. What we're saying is that you cannot come back and ask me a question after 3 years of what I have done 3 years back. Of course, as a professional, I'm required to keep the documents, my working paper, all of that. But that's unproductive, waste of time, waste of energy. And the income tax guy will always have the benefit of hindsight in asking us 10 more questions. And the more and more you probe, it's only coming back to, how should I put it? It's actually going back to the CA exams where I will ask you 500 questions, but you'll be able to respond to only 20 of them because, there are only so many to respond to. So how do we kind of, get ourselves out of this? Maybe through limitations.
See, certain good things around this is the way I do it is have a good, your engagement letter should be solid. Your working papers should be solid, rock solid in the sense that they prove what you did at that point of time and you could justify it. Basis that I did not have any knowledge of the future. I did it on the information which was provided to me. And how did I do it? If I have adequate backups of that good. Third good thing to keep is obviously at the time of closure, right? Confirmation of facts from the management itself. Taking a representation letter on confirming the facts. The draft report is fine. These are certain things which you can produce at that point of time. Look,
MPV, I think getting this question to you, how do we put this in our standard somewhere that you should not ask me a question after 3 years? Yeah, you can't keep giving the test again and again, right?
And I agree, Anil. I'm not denying it, but let's understand this is not for our profession alone. It's applicable for even an architect, an engineer, or a medical, everyone. For example, if somebody is constructing a building also, somebody can come back in hindsight and say it could have been designed differently. So I think the best protection in my view with the experience of audit is the standard valuation standard 201 and 202. These two standards very clearly spell out this is how you need to do the work. As long as you do the work as per that, I don't think any finger pointing can be done. For example, in audit standards also, while we keep hearing some external noise about regulators and all, my experience, the way regulators have eventually concluded, they may initially have a view, but eventually the conclude is, if you have evidence that I did work as per standard, I close it. I could have done beyond what is there in the standard is a different one. So that's where they initially start. But when you start defending it, they realize that, look, the standard wanted me to do only so much. And as long as I've done what was in the standard, you can't hold me responsible beyond that. I think that's where Rajan's point on that analysis and...
I know, MPV, it is very nice to sit and talk about all of this. But when a member faces this challenge and inquiries, life is taken away. You keep giving answers for 10 years.
Beautiful
so I'm
question.
saying, we can keep talking about, ethical values, getting it right, doing all the 500 things right. But it is that one thing that you would have probably not thought about at that point in time, right? Could be called upon as a professional judgment issue that you would have. So I'm saying there has to be some limitation of anything that you do in life. I mean, I don't know, I'm generally wanting to sound it off back to you, both of you all as experts here. My job is easier.
Beautiful question. That is why it's extremely important that people who are sitting on judgment on these instances of failure are people who have hands-on professional experience so that they can visualize that situation and accordingly address. Point number one. Second is it a gross negligence or negligence? So gross negligence means I could have seen it had it done reasonable effort. Only then it is gross negligence. Otherwise, if it is something which normally I could not have discovered and it missed my attention, then you can't hold me responsible. So that is why it's extremely important that any profession should be disciplined by a set of people who have hands-on professional work experience in that area. Otherwise, the judgments are likely to be inappropriate and whatever you mentioned. My view, that's the best remedy. As regards timelines, Anil, I do agree. I think we have to build that ecosystem that we should not go back beyond a particular point in time. I think we should all work towards that. Which legislation, how to bring it is a matter of discussion. As of now, generally, we don't go beyond 8 years. Whether it has to come lesser than that, I think time will tell. But here again, my experience, regulators, only in fraud cases, they tend to go very long back. But if it is not cases of fraud, they don't tend to go back beyond a reasonable period. That's my...
No. So one thing that people, valuation reports are questioned by income tax departments, for example. And they have been very rampant in questioning the valuation. So anyway, I was only trying to, while we could of course discuss and debate this and it can continue to happen, I was only trying to figure out, is there a way to protect us in disclaimers and caveats and limitations? So which I think both of you have answered reasonably well. So that was my only point. Is there some way that, we could do this? Yeah.
Anil, since everybody is listening, it's a very good point you raised. And Rajan mentioned this earlier. The September 20 guidelines very clearly provide that a professional cannot seek protection by giving a disclaimer or a limitation. That is not there. So each of them have boundaries on what needs to be done. And it is no way an insurance about any level of complacency in the work to be done.
Perfect. So MPV, we have another maybe 15 minutes. I wanted to, this is the first one. I just wanted it to be, 1.5 hours only so that we don't take away too much time of members on Sunday and still make it interactive. So let's just ask maybe the next 2 or 3 interesting questions, or if you have anything coming in from public, I'm not sure. Members.
In fact, there are almost about 60 questions which have come from the members.
This format is working out much, making it more interesting and interactive, I think.
So Sarika and myself have agreed on a WhatsApp that the next discussion will only do around DCF, 1.5 hours. and we can just pick up maybe even just one limitation and discuss about it for 1.5 hours. So I think might just come out to be interesting. Let's see where we go with this. But yeah, back to you, please.
Yeah. So Rajan, we'll make it a rapid fire one because there's so many questions from the members. We'll make it rapid fire. You could give just one line answers so that members who have put in the efforts of drafting these questions, at least reasonable number of them we would have answered. And Anil, between you, me, Sarika and Rakesh, we will see if we can compile these questions and put out a small document in the
Absolutely.
webpage. Is it possible? We will see. I don't think we can.
I think Sarika is already on top of that, so I think that's a good idea. I think we should do something like that.
I just want to caveat again to the members that we may not really do it, but we will certainly evaluate the possibility. So Rajan, here begins the rapid fire questions. So there are 3 lots which Sarika has forwarded so far.
So just for everybody's benefit, that was a caveat or a limitation or a disclaimer?
That's
interchangeably used to be used interchangeably.
All right. Back to you.
Maybe they are not interchangeable words. Come. So rapid fire, Rajan. 1. In semi-finished goods, a work in progress, or in civil works, realizable value cannot be easily derived. In such case, only cost incurred has to be taken. Whether qualification needs to be done or note will suffice. One line answers, Rajan.
Qualification this thing analysis should be done semi-finished. If it has been used, it's perfectly fine. If there are no plans to do the further construction, that CWIP could only be a waste for all you know, and you should write down the value. This is my judgment on it. And I'm trying to answer in a very, very brief manner. One-liners,
please. There's a question on DCF, which we'll take it to the next session. Valuation report is even adopt rate where the property is even under dispute for years, and even where publicly known that property developer is facing several cases. Then how can we even be near to reality, and does it have any legal validity?
Like I said over here, subject to the information you have, you should clearly lay out what information you have, and on the basis of that information, you should perform the valuation.
Okay.
Wherever there are too many, especially in the case of real estate, it is a very important thing for you to put out a caveat thereon about the claims if you do not have any information from home buyers and all that in your analysis.
Okay.
I would recommend that.
Okay.
No,
even
sorry, I will
data
MPB, you to discuss. I missed out the question.
Yeah, events after valuation, after data valuation, there may be lots of pressure from seller to accommodate events which have a positive impact. How to deal with it?
No, like I said, I typically go with the valuation date and my date of signing. If something actual has happened, which is showing a situation that this has happened and this has become a reality, like I gave an example of a plant getting washed away, then I cannot give that value, right? But if suppose there is a transaction which has happened where some asset has been sold at a particular price, which could be a surplus asset, I think I would factor that in my analysis when I'm doing the valuation in some way. How significant that event is what I do need to keep in mind.
Can a valuation report be issued without limitations and disclaimers?
I will never recommend that.
Any liability attached to professional for incorrect valuation?
A lot of liabilities, right? Because now you're after becoming a registered valuer, you're subject to rules and regulations also by IBBI. So there is this thing. Recommendation to all the fellow professionals is please do take some professional indemnity or insurance when you are embarking on this.
Yep.
How to deal contravention between business valuation versus valuation under Income Tax Act?
Income Tax Act, a lot of valuations are rule-based and prescriptive. The tax rules themselves are laying out what needs to be done. They are not providing a lot of subjectivity to the valuer. So they are more mathematical, whereas when you're doing a business valuation, in another context, you are doing more of application or more analysis in certain ways. Barring under 56(2), where you could be doing a DCF for an income tax, but otherwise, primarily the valuations are more mathematical. And the results from using a valuation methodology, using a DCF, multiples and all that could be totally different from the valuation which you may do under the income tax. So hence, please clearly spell out that this valuation is being done only with this perspective in mind.
There's a query or seeking guidance in the context of RERA valuation. Some guidance with reference to disclaimers, limitations, and caveats.
With respect to RERA?
RERA.
Yeah. So I think the critical thing on that is I would still do I will try to use two methodologies, which could be the development of the project. Similarly, I would also look at the market multiples. At the end of it, I need to corroborate the results using both. I would do that. However, I need to give out or clearly spell out the caveats around the RERA thing, how they are going to impact my project, which could happen. There could be delays and all that. What claims do I have? I need to get all that data, which should be clearly factored out. In case you are not able to get that data, you should clearly spell that out in your report.
Yeah. There's another query. We are doing an assessment of a loss claim during a forensic assignment. Are we supposed to go by valuation standards? We find the data given by management and data in the auditor's financial statement as well as in bank statements are at variance. Should we treat this as a limitation or disclaimer?
See, you are doing a claim compensation, so it's not a registered valuer valuation, this thing in that sense. So I would leave that out in the first thing. You're performing your job as an independent assignment as an expert, right? So as a forensic accountant, whatever data which I'm going to be using to come to a claim compensation is what I should spell out. I'm not doing a valuation as a valuation standard, as a registered valuer or as a CA performing a forensic audit. I'm assuming that you're filing your report as an expert, independent expert, which is in your individual capacity. So whatever data which you are using is what you should spell out and what analysis you could perform on that. Wherever you could not bridge the gaps between the two data sets, that should be clearly spelled out, because that is a limitation in your work which can influence the claim compensation also.
The next query, EBITDA or gross profit margin projected by management is, say, 25% higher than past trend. Is it not wise to accept that and provide an additional risk premium in the cost of capital? I need not mention this in the limitations or caveats. Instead, simply capture it in additional cost of capital. Will it not absolve the registered valuer responsibility?
See, one is obviously when you're saying the margins are increasing at this thing, I'm sure you as a valuer would have analyzed what are the reasons or causes for it. However, if you think that these projections are bordering on improbability or surreal, so you need to make an adjustment. So now over there in ideally, I would write down the storyline where I am disclosing my cost of capital calculations. I would put the risk-free rate, I would put the market risk premium, and then there is this thing called the alpha or a beta or the delta, which we call, that's my judgment, right? And that's where I would justify it, taking into account the achievability of all these numbers. I ascribe a 5%, 7% or whatever, but that should match up with the storyline, what you're talking about, to take care of it. It should not specifically be said that this thing, you are disclosing it, that this is an additional risk premium which you are considering in your report, whatever is there. And so that should be good enough, but keep your adequate working papers so that tomorrow if you are called, that you can justify why you you use a delta of this percentage, but over here I've applied this extra on this basis. That's judgmental. What you want to apply.
And if I can share my personal view, of course, I'm not a subject matter expert like Rajan. I would be very cautious in adopting that approach. I would rather moderate the EBITDA projections and take a more relevant cost of capital. So, which is what we would normally do in a impairment valuation. So Rajan, the next question, which is a very interesting question. Does the
you cannot become a good valuer, right? You're always conservative.
No, that is not conservative, Anil. That's the right value. I'm against conservative. I'm against conservative. Valuation can never be conservative, nor can it be higher. You have to get there, right there you have to get. And in our valuation standards, contrary to some of the international standards, we have very nice concept of a range of valuation. I still recall we almost debated for about 3 full days among a group of 14 experts before we concluded that a range of valuation is a very appropriate way of communicating value. Any case, getting back here, since you asked me to close, this is a good question. I would like to carry as much questions as possible from members. Does the valuation report discount the impact of limitations in arriving at the value for the purpose of reporting by putting numbers to the limitations to the entire exercise? Like, for instance, does the valuation have any utility for users without being realistic? Because for he would like to see numbers to all the disclaimers and limitations. Else it becomes something like an audit report where understanding it for a user is very tough ask with so many caveats, etc. Rajan, while you answer this, from audit report point, I want to tell, in audit report we quantify. Rarely are there circumstances where you don't quantify. So over to you, Rajan.
See, that's what I'm saying. The important thing is the story or what you present out when you're doing a valuation. Each and every, if you are able to justify whatever numbers have been given to you, that these are the underlying assumptions which have gone into it, whether I agree with them or I don't agree with them, and why, if I agree with them, what is the management's action plans which are justifying all that. If I've factored all that in my analysis and I've kept that as an assumption. Now again, the question comes about the disclosure which I'm doing, because like I said, it is a case-by-case situation. I have to keep in mind confidentiality of the client. He may want a summary report only to go out because other party may not have access. If someone wants a backup, whether that can be provided to him, it all depends on what is your contractual thing with the client also. So long as I perform a proper review and analysis of the historical, the future which has been given to me by the management, and then I form my own judgment whether I want to accept, I want to downsize the projections, or I want to capture a higher risk rate. It's that as a valuer is my this thing. I need to be able to, because what does even the guidelines say? That in case your report is picked up for any questioning or in this thing, the valuer through his working papers or through his report should be able to justify the work which it has done, and his work should be able to withstand the judicial scrutiny. So the important thing is the disclosure can depend upon the nature of engagement. But what work which you've done and the working papers which you may have, those are very crucial for you if there is a question mark going on or a question gets raised on your valuation.
Okay. So, Rajan, the next question, there's an observation from a member. Why ICAI Council is not allowing chartered accountants to do valuation of land and building as well if we have requisite qualification as per IBBI? Land and building valuation constitutes 50 to 60%. I'd just like to clarify to the member that we did debate this. I'm not able to offhand recollect the reasons, so it will not be fair for me to respond to it, but it was certainly discussed. In case we get an opportunity to interact again, we'll certainly share with you. Sarika just helped me to look at those minutes and update me and Anil so that next time we interact with the member, we'll be able to give him the needful clarity on this. But I do recall we debated it quite a bit. And Rajan, here is a question for you. From a legal standpoint where the report may be tested in a court of law, please clarify if the limitation clauses must specify the efforts of the valuer to overcome the limitations.
Well, that you can justify from the working papers and all that which you have kept, right? If it is going to come up for scrutiny, whether it's by writing the letters or you tried fixing up the meeting, but you could not get it. It's there, it's correspondence, it's documented, you kept it in your records, which can be shown to the scrutinizer. I think that should be good enough.
Okay. The next question, should we need to add a disclaimer or limitation regarding the beta assumption, especially when we do valuation of a private limited company, when peer data is not available in the public domain?
See, like I said, over here, whenever I'm doing private company, what I'm trying to do is I try to pick up companies in that domain or industry. And I try to work out that beta for those. And then I recalculate or rework the beta for my company. I do not blindly accept or apply a beta of 1, which a lot of people tend to do because it's a private, so I've applied a beta of 1. Yes, if you do not have anything to justify or any support available to you why you're doing it, then you can write around that. But if I am able to identify or find out companies in the space in which this company is also operating, I should use that as a base, work out, and then try to do it.
But these don't become qualifications or limitations or caveats. They become actually notes to your workings, right?
They become a note to the working, or when I'm putting the sheet around the cost of capital computation, I write RF is based on 10-year zero coupon bonds. Beta calculation based on taking into account the debt equity of this company as well as others in that
and also
space.
Comparable, you put them in and stuff
I
like
may
that.
put the names or not, but I may write over there that other players in that space. That's how I would do that.
So Anil, you can, there are lots of questions, almost about 80 questions.
No, I think it's interesting. I think we have more than 100 questions.
My apologies to all the members that all the questions could not be answered. In fact, many of the questions are generally around valuation reports and things like that, not specific to the topic. We will see how we can address these questions in our subsequent Sunday interaction meetings while taking up those specific topics. But sincerely appreciate the members' interest. And I found the questions very challenging, actually, very challenging in the sense that they are on the ground, real issues faced by the members. And I think it's important we interact and give guidance. So thanks, Anil, for the opportunity to interact with.
No, I think this has been really, really fantastic. Very lively discussion, and I must really thank Rajanji for taking your time out on a Sunday, which is of course so important from a family time perspective. And thank you, MPV. I think you being there also made all the difference in terms of our discussion and the quality of the discussion that we've had. I'm actually encouraged to try and see if we could do this every Sunday. But of course, I will reach out to Sarika and see how well we can do that and continue to keep the interest of members and also continue to keep this light, because that might become more and more interesting. And we can pick up some specific topics with suggestions from Rajan and everybody coming in terms of, what we can discuss. So I think thank you, everybody. Very good afternoon. I think we have transited into afternoon. Have a good day. Be safe. We would love to catch up with you again next Sunday, I believe. Again, around Sundays with valuation experts. It's like a television series. So please do come and connect with us. And thank you, Rakeshji and Sarika, for this organizing this and getting it right. And we would again love to interact with you, Rajanji. And again, invite you on a platform to discuss nuances of maybe valuations or any other topic, which I'm sure you'll be able to add a lot of value around all of those. So thank you once again. And Sarika, back to you. Would you like to conclude this today, Sarika? Yeah, thank you.
Pardon, sir? Yeah.
Yeah, I'm saying you can conclude it.
Yeah. Many of the members have this question that if RVO members can get the CP hours. Actually, IBBI has allowed only 100 participants to be in one CP training. So these are open discussions. Number of participants can add.
So we'll discuss this again, Sarika. I think let's figure out internally what we can do around it.
But
yeah, your voice is not very clear, Sarika.
Yeah, sure, sir.
Your network.
Thank you all of you. We request you to kindly join on. Yeah. We request you to kindly join again on 6th of June, as sir has already informed that we have a webcast on DCF. We'll take up DCF, valuation of shares under Income Tax and under Companies Act again. And we'll request all of you to join. Thank you so much, sir. Thank you all.
Thank you. Have a nice day. Stay safe. Take care, please.
Stay safe. Thank you so much. Bye-bye.